The fastest way to lose your money is not to gamble. It is to follow the rules you were given. And right now, in 2026, the rules are changing under your feet, and nobody with a microphone is telling you what it really means for your paycheck, your rent, and your retirement. This is not financial advice. This is financial education, and it is going to be uncomfortable. Because the uncomfortable part is the point. You have been taught that currency is just money, that governments borrow and repay like a normal household, and that markets move because investors are rational. That story was built to keep you calm. But the data does not behave like a bedtime story. In the real world, currency systems are battlefields, and whoever controls the battlefield decides who eats and who starves. In the last few years, you have felt it in your daily life. Prices did not just rise. Your salary stopped stretching the way it used to. Interest rates rose and then came down, but your purchasing power did not magically return to 2019 levels. Meanwhile, housing detached from wages in the United States, the United Kingdom, Canada, and Australia, turning home ownership into a lottery you can never win twice. And while you were drowning in everyday bills, the stock market kept finding excuses to hit new highs. That disconnect did not happen by accident. Systems do not accidentally produce winners while most people lose. And here is the part nobody wants to say out loud. The next chapter of wealth transfer is not only about stocks, it is about money itself. It is about how a country pays its debts, how it defends its currency, and how it can outsource parts of that power to private networks. In the middle of that is a phrase you have heard everywhere online: stablecoins. They sound boring, they sound technical, but stablecoins are not just another financial app, they are a lever. So what will you learn here? You will understand how the United States handles debt stress when global buyers hesitate. You will understand why stablecoins can pull value toward the issuing ecosystem, even when the official story says it is just faster payments. You will understand why the same pattern shows up during financial revolutions. The people who cling to old promises get diluted, and the institutions with early access get to rewrite the rules. And you will understand why this matters in 2026, when AI is already reshaping employment, insurance markets are breaking under climate risk, retirement systems are underfunded, and total global debt keeps climbing toward numbers that stop sounding real. But let us start with the simplest shock. In modern history, when the dollar weakens hard, everyone feels it at once. The currency is not an island, it is the oxygen of global pricing. When the dollar loses strength, imported goods get more expensive, financing gets harder, and the real cost of risk spikes. You can see it in commodities, in shipping costs, in the cost of servicing loans denominated in dollars, and in the daily math of inflation at the grocery store. According to historical patterns around major currency stress, there is often a political theater moment where officials insist everything is under control, while the economic machinery quietly changes its operating logic. The last time we saw something comparable on a global scale was during the era when gold no longer anchored the dollar in the way people had assumed. That change was not gentle. It flipped the playbook for the entire world's wealth storage. Now compare that to today. In 2026, you are not only dealing with an economy that has higher rates and higher debt, you are dealing with an economy where the financial infrastructure increasingly runs through private platforms, tokenized rails, and regulated intermediaries. Stablecoins sit at that intersection. They are designed to behave like cash, but they can move like software. And when money behaves like software, control becomes easier for the people who build the code and negotiate the liquidity. Pattern interrupt. Imagine this: it is a Tuesday afternoon, and you are a 34-year-old customer service worker who just got laid off because an AI tool replaced half the call volume overnight. You apply for jobs that now require fewer entry-level roles and more workflow literacy. You find a new position, but it pays slightly less in real terms because inflation is still eating your paycheck. You look at your bank account and you think, at least it is safe. Then you see headlines about stablecoins. It feels like a niche tech story, far away from your rent. But what if stablecoins are not far away? What if they are how money circulates when governments need help financing themselves without paying the price that used to come with debt stress? And here is where anger turns into understanding, because the mechanism is concrete. When markets doubt a government's ability or willingness to manage debt, the price of funding rises. That shows up as higher interest rates on government bonds. Higher rates mean higher costs, which can force austerity or monetization. A government has a few options, and each option has a victim. One option is to lower rates. That can stimulate the economy, but it also weakens the currency and can reignite inflation pressure. Another option is to expand the balance sheet and increase money supply. That provides liquidity, but it can quietly devalue the purchasing power of the public. Another option is to create a global environment where other investors absorb the debt anyway, sometimes by offering high yields, sometimes by tightening the economic screws on everyone else. In 2026, the official language is still polite. Policymakers talk about liquidity, stability, and market functioning. But you do not need a PhD to recognize the pattern. If foreign buyers refuse to hold a country's bonds, then domestic buyers must step in. If domestic buyers also hesitate, then the government has to do something that shifts risk back onto households and taxpayers. Now, you may ask, why not just let it work the normal way, where governments pay and investors demand compensation? Because in a global system, debt is not just math. Debt is power. The United States did not become the dominant financial country by being weaker. It became dominant by building a system where its currency stays at the center of global settlement and its debt stays at the center of global collateral. But in every period where dominance is questioned, the system adapts. And stablecoins are a way to adapt without asking permission from the traditional bottlenecks. Let us talk about debt stress for a moment. In the story you were told, when a government hits a debt ceiling or debt constraint, it negotiates, it delays, it reaches an agreement, and then everything continues. That is the public version. The real version is more transactional. Debt stress often shows up as a funding gap and a market test. Can the government issue debt and still find buyers at manageable yields? If global investors hesitate, yields rise. If yields rise, the cost of refinancing rises. That can spiral. So what does the system do? It tries to ensure that even if one class of buyers steps back, another class steps in. Sometimes it is domestic pension funds, sometimes it is banks, sometimes it is foreign central banks that still hold reserves, sometimes it is global risk appetite shifting into the safety trade. But increasingly, it is also technology and private settlement rails. Pattern interrupt again. You have seen how quickly apps moved money compared to older systems. You can send funds across borders with fewer steps, sometimes with less friction than traditional banking. Now imagine that those funds are not held in a neutral vehicle. Imagine they are held in something that tracks a target value and is issued through a web of companies tied to U.S. financial markets. If that web buys short-term U.S. debt, then global demand for U.S. debt increases through a channel that does not look like foreign central bank buying. It looks like payments. This is where stablecoins stop being an innocent convenience feature and become a financial pipeline. The pitch is always the same: faster, cheaper, more accessible. The hidden part is what absorbs the liquidity. When stablecoins are issued, the backing assets matter. In many common structures, the issuance companies park reserves in short-term instruments. Those instruments can be U.S. Treasury securities and related money market assets. That means the stablecoin ecosystem becomes a demand engine for U.S. debt. And that demand engine can be scaled by marketing, partnerships, distribution, and interest incentives. It can also be scaled by compliance, because regulated issuers and platforms are easier for institutions to adopt. That is the first escalation, not a revolution of politics, a revolution of money movement. Now, you might think the word stable means safety, but stability is a business model, not a moral guarantee. A stablecoin is stable relative to a target, usually a dollar, but the system that keeps it anchored depends on liquidity and reserves and the ability to redeem. If redemptions spike or reserves are stressed, stability can fail. The risk does not vanish because the branding is smooth. Still, even with those risks, the stablecoin ecosystem can function as a stabilizer for U.S. debt demand. That is what institutions care about. They do not need stablecoins to be perfect. They need them to be widely used enough to route flows. And that takes us to a second 2026 reality that you cannot ignore. Wealth concentration is accelerating. The top 1% owns more than ever, not just in terms of stocks, but in terms of financial leverage and asset-backed control. According to widely cited research and financial reporting trends, the share of wealth held by the top segment continues to rise because they own the assets that inflate during asset booms. When the government supports liquidity, those asset values rise first, while wage earners face the later and slower pain of inflation and job disruption. In 2026, you are watching AI reshape jobs faster than career advice pages can digest. The learn-to-code suggestion from 2020 was not only incomplete, it aged like milk. AI can write code, test it, and deploy it with less human input than most entry-level workers expected. So yes, millions need reskilling, but millions also face a simple truth. The labor market does not care how hard you tried, it cares how replaceable you are. So households fall behind while assets remain supported. Stablecoins fit into that same ecosystem because they connect new liquidity to the financial products that institutions already prefer, especially US dollar instruments. Now, here is where the story gets darker, because you are not just discussing personal investments, you are discussing state sovereignty. When a country's people use a foreign-issued stablecoin for daily transactions and savings, the local currency loses its role. That local currency loses the tax base and the inflation tax channel. Pattern interrupt. Think of inflation tax as this. When money loses value, governments can effectively capture value through the erosion of nominal obligations. If you print or expand money, or if currency depreciates, debts and taxes behave differently. Even when it is not labeled as a tax, the outcome functions like one. The government gets room to spend because the public's money buys less. But if citizens convert their money into a foreign stablecoin, the erosion happens to the foreign anchor, not the local one. The local government loses a major tool. It also loses seigniorage and loses the ability to fine-tune monetary conditions through local credit creation. That is why stablecoin adoption is not merely a financial trend, it is a geopolitical event. The Vietnamese transcript mentioned Nigeria as an example. Whether or not you like that framing, the underlying economic pattern has been visible across multiple countries. When local currencies face credibility issues, people seek alternative stores of value. They move toward hard currencies and increasingly toward dollar-linked instruments that can be accessed through mobile networks. Imagine Nigeria in a moment of stress. The government has to make decisions about subsidies. It cuts fuel subsidies, and suddenly the cost of living rises. That shock hits foreign exchange demand. If the currency weakens, people rush to move money out of the local unit. Banks struggle to meet withdrawal demand. The central bank burns reserves defending a rate that markets no longer trust. Then policy tries to tighten controls, and controls fail because payment networks do not stop at borders. You can restrict exchange in one channel, but you cannot fully stop a fast, liquid, globally reachable instrument from being used elsewhere. In such environments, stablecoins and dollar-linked alternatives can become the middle ground between complete capital flight and forced local currency use. The result can be a local tax and liquidity squeeze. That government then faces a painful choice: cut more spending, increase taxes, or accept currency deterioration while losing monetary control. And now bring it back to the United States and the European Union. If stablecoins route transactions into a system backed by U.S. Treasury or related instruments, then the stability of that pipeline supports U.S. financing. While local governments abroad get squeezed, U.S. debt demand can remain resilient. This is not fantasy. It is how modern financial plumbing works. The question is not whether the impact is real. The question is who benefits and who pays. Now we escalate once more, because there is another layer. Even when stablecoins seem optional for users, institutional dynamics can make them hard to avoid. Platforms get incentives. Apps integrate stablecoin rails. Large payment processors support them. Marketing emphasizes lower fees and faster settlement. At the same time, global insurance and climate-driven disruptions are pushing costs upward. In 2026, more regions are paying for higher disaster risk through insurance premiums and reduced coverage. When insurance collapses or becomes too expensive, migration costs rise. Communities relocate. That creates economic stress, and stress creates a demand for liquid and widely accepted payment instruments. When demand for liquidity rises, the fastest and most widely integrated rails win, and stablecoin networks, especially those tied to dollar liquidity and compliance-friendly frameworks, can become those rails. So you get a perfect storm. AI job displacement reduces household resilience, inflation reduces purchasing power, housing affordability breaks, insurance risk increases costs, and retirement systems get pushed later while Social Security sustainability remains a political battleground. Then, as households look for ways to survive, the financial system offers them convenience through stablecoin-based platforms. That is how you turn survival needs into adoption. But there is a more technical and even more dangerous idea in the transcript that deserves your attention. Stablecoins can shift how debt instruments are held and circulated, potentially turning what used to be external demand into internalized demand. That means the U.S. might become less dependent on global central banks and more dependent on a domestic or quasi-domestic ecosystem of financial institutions and tokenized settlement. This is where the Fed, banks, and regulatory choices matter. If regulators ease capital requirements and adjust risk weighting or liquidity rules, banks can expand credit creation and buy more assets. In plain terms, a set of accounting and regulatory changes can increase the effective purchasing capacity of financial institutions without requiring new real savings from households. Now, you do not need to read a balance sheet to understand the effect. When financial institutions can create more demand for government debt, government funding becomes easier. But the costs do not disappear. They move. They are embedded in future inflation dynamics, in credit conditions, and in the eventual tax burden. Pattern interrupt again, because this is the exact moment where people usually stop listening. Picture a small business owner in 2026. You see higher borrowing costs. Your clients delay payments. Your supplier prices jump. You think at least the government can keep the financial system stable, but stability has a price. If the government keeps funding itself by enabling leverage in the financial system, then the eventual correction can hit consumers through higher rates, higher taxes, or tighter credit. And now imagine this stablecoin ecosystem as an additional buffer layer that smooths demand. It can reduce the immediate fear of bond sell-offs, making policymakers more willing to keep policies that support asset markets. That sounds good for indexes. It sounds less good for your rent. Now, let us address the 1973 gold and dollar separation analogy in a cleaner way for modern readers. When a currency regime shifts, it can look temporary at first. People keep using money like before, contracts remain denominated. Then, quietly, the valuation basis changes. Investors adjust, prices reprice. The anchor breaks. Stablecoins are not the same as gold to dollar decoupling, but they represent a similar theme. The system is evolving away from public, state-centric control toward private, network-centric settlement with state-aligned backing. The anchor becomes less about national policy and more about the ability of global networks to root value. So yes, the history metaphor matters. But the crucial difference is speed. Technology can accelerate adoption. If a currency shift once took decades, a stablecoin-based shift can take months if distribution is strong. That is why people who call this merely a crypto trend are missing the point. Crypto is the marketing wrapper. The real story is financial power. Now you might wonder, if stablecoins are backed by dollar assets, why not just use dollars directly? Because stablecoins are easier to move, easier to integrate into apps, and often cheaper across borders. Because compliance and market access make stablecoin issuance attractive for institutions that want dollar exposure without dealing with some of the friction of traditional banking. Also, stablecoins can be made to pay interest or be used in yield-bearing platforms, depending on jurisdiction and business model. Even when that interest is not guaranteed, the ecosystem can compete for liquidity through incentives. That pulls money in waves. And when money comes in waves, bonds and liquidity instruments get supported. When outflows happen, markets can reprice risk. The system is not neutral, it is engineered. This is why, in the transcript, the phrase Pennsylvania Plan appears. You can treat the naming as rhetorical. The underlying idea is what matters, the intention to use a stablecoin adoption wave to increase U.S. debt absorption and to turn debt holding into an internal circulation process. It is a strategy of converting global settlement preference into balance sheet support. There is another component in the transcript that you should not dismiss, the claim that stablecoin adoption can influence local interest rates or financing conditions indirectly. Even if a government does not directly set stablecoin interest, the flow of savings away from local banks changes the supply of local credit. That affects the ability of local banks to offer loans and the rates they must charge. When a large share of value migrates out of local banking channels, the local banking system faces a liquidity and funding issue. It may respond by raising rates, tightening credit, and cutting services. That is not conspiracy. That is standard monetary transmission. It just happens through new payment instruments. Now, let us connect this to your life again, because this is where the dark truth becomes useful. In 2026, many people are stuck between two fears. Fear number one is job loss from AI. Fear number two is financial ruin from inflation and housing costs. Stablecoins